Thanks very much, Shane, for joining Blue Notes again. It's a few weeks now since the interim result. You've had a chance to talk to a range of investors. Is their view of the result any different now a few weeks down the track to what you heard straight after it?
Well, inevitably yes, because people have time to kind of digest your numbers and do a bit dig through and what's really driving in there. But I'd say the overall tone is still pretty much the same, but there's a lot more nuance that people are digging out of it. And of course the really important thing is they like to compare you to everybody else. And so, at the time when we announced, we'd only just had the NAB result, but then obviously we had Westpac and NAB, so they get into the detail of who looks better than everybody else. So a lot of it's more nuanced today.
So how was ANZ compared with other banks when you spoke to investors about that result season?
Oh, I think in general, actually, ANZ came across pretty well, and I think if anything, we probably surprised a little bit to the upside in terms of the growth that was coming through and the diversification in our business. But actually, in reality, I've been saying to people, when I think about I've seen about 20 investors since then, 80% of every meeting has been focused on one issue, and that issue is about capital.
Capital was obviously then an interesting question, and we saw NAB do something different to ANZ. What were the implications of that?
Yeah, so you're right, there was two things. We've had the FSI, so that kind of put capital on the map, even more so than it perhaps would have been otherwise. Basel IV, there's been more noise about Basel IV and what that means. And of course we've had APRA being a little bit more vocal about its expectations of the bank. So all of those things have kind of conspired to make capital really, really important. And then you're quite right, NAB came out with a pretty surprising and big change in their own views in terms of the structure of how they run the bank. And then this big $5.5 billion capital raising. So everybody kind of says, well, if they're doing that, what are you doing and why?
And when we see the analysis by the analysts, they talk about the quantum of capital that may need to be raised. Less discussion on the options for getting there and the time frame for getting there. Is that the sort of thing that you talk through?
Sure. I mean, essentially we talk through a few things, which is, we don't know, as of today, we don't know exactly how much capital we're going to be asked to hold by the regulators, right? We don't have a perfect answer. I'll talk about what we think it might be, but we don't have a perfect answer. So we don't know how much. We don't know by when. So we're not sure what the timetable or how quickly we have to get there. And we're not sure in which form it's going to come. So, there is ideas that it could be increasing our DSIB, this general surcharge, which is just an ask of overall, or it could be about fiddling around with the required RWA on, say, mortgages. And that has an impact on your business mix and who it impacts more than others. So we don't know how much, when, or kind of in what form it's coming. And so really we have to stand back and say, our view is that there's definitely going to be asked to hold more. We think that the regulators are going to be much more interested in having an orderly transition towards that having more, and therefore they're going to give banks time to do that in an organic and kind of sensible way rather than a rush. And right now our bets would be that it's more likely to come in terms of some changes to the way that mortgage risk weightings are calculated rather than a general application. So we kind of sit back and say, with those unknowns, that there's multiple ways to get there. And then we say, what are the options that we have as a bank? Well, we have the same options as everybody else. We can continue to grow capital organically by, through our retained earnings. And we do that pretty successfully every year. We've got that. We continue to have a dividend reinvestment plan that kind of, essentially allows our investors to put some of their dividends back into the bank. That's a way of generating capital. We have the options to put discounts on our DRP, which makes it even more attractive and raises more money, or even to what some of the other banks have done is actually have it what they call an underwritten DRP, which even gets more. So we've got the same options as everybody else.
Finally, over the last couple of months, we've seen a big sell-off in banks. Was there a sense that the investor community thought Australian banks now were yesterday's story, for example?
I don't know that they're yesterday's story, but I think the investors are starting, when they read through, and again, not just ours, but they read through the results and including the update from CBA, they're starting to ask some questions about the sustainability of growth. And it was more about, maybe the growth is slowing in the sector in terms of revenue opportunities for us all. And when you couple slower growth and at the same time asking for more capital, there's the obvious questions of what is that going to do to returns? And so I think there's a few questions out there. There's quite a lot of unknowns about what's APRA going to do, when are they going to do it, as I mentioned, how are you going to raise the capital? And when there's that little bit of uncertainty, there's a bit of it gets translated, if you will, into an uncertainty discount on the stock prices in the meantime. It's still, the prices of the banks are still pretty good, and you look over long periods of time, we're trading at pretty healthy levels, and I think that initial reaction down is now kind of balanced out, and now people are more focused on the fundamentals.
Look, thanks again for your time, Shane, and look forward to talking to you again after a trip to Silicon Valley in coming weeks.
Thank you.